Imagine sending a message that tells a bank to move millions of dollars. The message crosses a continent, then an ocean, then another financial system, and somewhere on the other side, a bank receives it. The transaction begins. But there is something strange about this process. The network carrying the instruction does not actually carry the money. It carries information. This is the basic idea behind SWIFT, a global financial messaging network used by banks and financial institutions to communicate standardized information about transactions. It sounds simple, but the scale is extraordinary. Banks across the world need to communicate constantly, and they need a common language. Because without that language, moving value across borders becomes much more complicated. SWIFT helped create that language, and in doing so, it became part of the architecture of global finance. Before modern financial messaging, banks had a problem. Different institutions used different systems, different formats, different procedures, different ways of describing transactions. As international banking expanded, the problem became larger. A bank in one country needed to communicate with a bank in another. The information had to be precise. Who was sending the money? Who was receiving it? Which bank was involved? What account was affected? What currency was being used? And what exactly should happen next? A small misunderstanding could create a very expensive problem. The financial system therefore needed standardization, a common structure, a common vocabulary, a reliable communication network. That was the opportunity. Instead of every bank building a separate communication relationship with every other bank, they could connect through a standardized network. The complexity could be centralized into the infrastructure, and the banks could focus on the transactions. This distinction is critical. SWIFT is not a bank. It does not hold your checking account. It does not decide whether your bank should lend you money. And it does not simply take your dollars and deliver them to another country. Its core role is communication. Financial institutions use standardized messages to tell one another what needs to happen. That message can initiate a chain of actions, but the actual movement of funds happens through the banking relationships and settlement systems behind the message. Think of it like air traffic control. Air traffic control does not transport the passengers. It coordinates the information required for aircraft to move safely. SWIFT operates at a similar conceptual layer. It helps financial institutions communicate, and communication is the foundation of coordination. Without reliable communication, a global financial system cannot operate at scale. Now imagine a company in one country paying a supplier in another. The sender's bank receives the instruction. The receiving bank needs to know what is happening. But the two banks may not have a direct relationship. So another institution may sit between them, a corresponding bank. Suddenly, the payment has become a chain. Bank, message, corresponding relationship, settlement, receiving bank, and eventually, the beneficiary. To the customer, it may look like one transfer. Behind the scenes, it can involve multiple institutions. This is why international banking is so different from handing someone cash. The global financial system is a network of networks, and every additional connection introduces another layer of coordination. SWIFT provides one of the communication layers that allows those institutions to understand one another. The message travels through the system, even when the money itself travels through something else.
There is an important lesson here. Standardization looks boring until you see what it makes possible. Imagine every bank using a completely different format. Every international transaction would require translation. Every new relationship would require new technical integration. Every institution would need to understand the systems of countless others. The cost of coordination would rise rapidly. Standardization changes that. Once institutions agree on common structures, the network becomes easier to expand. A new participant does not need to reinvent the entire system. It can adopt the standard, connect, and communicate. That is how infrastructure scales, not by making every participant unique, but by creating rules that allow different participants to work together. SWIFT became powerful for precisely this reason. Its value is not simply in sending messages. Its value is in making global financial communication predictable, and predictability creates scale.
Global trade looks physical. Containers move, ships cross oceans, factories produce goods, aircraft transport products. But behind every physical transaction, there is often a financial transaction. A manufacturer needs to pay a supplier. An importer needs to settle an invoice. An exporter needs to receive revenue. A company needs to manage currencies. Banks need to communicate. And financial institutions need to coordinate across borders. This creates a hidden layer beneath global commerce. The physical economy moves goods. The financial system moves value, and the communication infrastructure connects the two. That is why financial messaging networks are more important than they appear. They are not visible when a container leaves a port. They are not visible when a factory ships a product. But somewhere, banks are communicating. Instructions are being verified. Payments are being coordinated, and obligations are being settled. The global economy depends on both layers, physical infrastructure and financial infrastructure.
Once infrastructure becomes essential, it can become strategic. A network used by financial institutions across the world is no longer merely a technical service. It becomes part of the architecture of international finance. That creates a difficult reality. Access matters, connectivity matters, and the ability to communicate with the global banking system can have enormous economic consequences. When financial relationships are restricted, banks may face greater difficulty communicating with international institutions. Companies may face additional friction, alternative channels may become more important, and governments may look for ways to reduce dependence on external financial infrastructure. This does not mean one network controls the global economy. The system is far too distributed, but it reveals something important about infrastructure. Power does not always come from owning the entire system. Sometimes it comes from occupying a critical layer within it, a communication layer, a settlement layer, a payment layer, a network layer. When enough economic activity depends on that layer, its strategic importance increases.
No infrastructure remains unchanged forever. Technology evolves. Trade patterns change. Countries develop new financial systems, and banks adopt new ways to communicate. Digital payment networks are expanding. Regional financial systems are becoming more sophisticated. Central banks are exploring new forms of settlement.
and private companies are developing new financial technology. This does not necessarily mean the old infrastructure disappears. More often, the system becomes layered. Traditional networks continue operating. New networks connect beside them. Regional systems emerge, and financial institutions gain more options. This creates something interesting. The future of global finance may not be one network replacing another. It may be a world of interconnected financial rails. Different systems, different regions, different technologies, all communicating with one another. The challenge will remain the same. How do you make different financial systems trust and understand each other?
For centuries, financial infrastructure was largely physical. Branches, paper, telegraph lines, clearinghouses, bank vaults. Then it became digital. Now it is becoming programmable. Financial transactions can increasingly interact with software. APIs can connect financial services. Automated systems can trigger payments. Digital platforms can embed financial services directly into software. And intelligence systems may eventually initiate transactions themselves. That changes the role of financial infrastructure. It is no longer only about moving information between banks. It becomes part of the software architecture of the economy. A business application can initiate a payment. A platform can verify identity. A machine can purchase a service. An AI agent could potentially coordinate financial activity. The boundary between software and finance is becoming thinner. And when that happens, the infrastructure behind money becomes infrastructure behind software itself.
The global financial system can appear almost magical. A company sends money across an ocean. A bank receives an instruction. A transaction is confirmed, and value appears to move almost instantly. But behind that experience, there is infrastructure. Banks, correspondent relationships, payment systems, settlement systems, and communication networks. SWIFT is one layer within that architecture. It does not carry your money like a truck carries cargo. It carries the information that allows financial institutions to coordinate. And that distinction reveals something much larger. Modern civilization does not run only on physical movement. It runs on information about movement. A container needs logistics. A payment needs communication. A bank needs trust. And a global economy needs systems that allow all three to coordinate. The more interconnected the world becomes, the more important those invisible systems become. Because the most powerful infrastructure is often not the infrastructure carrying the thing. It is the infrastructure telling everything else what to do. NEXNET, the architecture of modern civilization.